Foreign exchange might not be the first asset class investors think about when developing their investment strategy, but Credit Suisse's Prendergast, Head of Financial Market Analysis, explains why they should pay attention to FX. You've been analysing the FX markets for the past 23 years now. Are you still sometimes surprised by the reaction of the markets?
Yes, I really am. Very often surprised. I think that the great thing about markets and the reactions that they show is that they reveal so much really about human behavior on the one hand, which of course can mean people have panic reactions, or we suddenly react to a piece of news in a way that we don't fully understand exactly why we react in this way. But I think the other big interesting thing that drives it is often deeply embedded market positioning. Sometimes the reaction can surprise you and reveal just how deep and vulnerable certain positioning is. We saw that recently, for example, with emerging market fixed income, a really big reaction to the gradual rise of core yields.
And foreign exchange isn't always the first asset class investors think about when developing their investment strategy. Why should they nevertheless consider it?
Well, I think a lot of investors have quite a significant amount of foreign exchange exposure in their portfolio, sometimes not entirely realized because it can also be indirect. A certain stock could have very high exposure to one foreign country or earnings from that country. So I think one of the big things is realizing how much your portfolio is connected to foreign exchange. The second thing is that, of course, there's opportunity. There's risks, but there's also opportunity. And I think there are big swings in currency markets that happen over time. And if you can get on the right side of one of those big swings, it can really enhance total returns. On the other side, it can also, of course, increase risk, and this has to be balanced quite well. I think the third thing is that if you are in a country where inflation might be higher than the short-term interest rate, you're losing purchasing power, and you can avoid that to some degree potentially by diversifying, and through foreign currencies would be one really interesting way to do that.
And are there any megatrends in FX which could help investors better plan their long-term strategy?
Well, I think in FX we do have some what you could call mega trends, in the sense that you see over time certain types of country yield a positive currency return. So I'm thinking particularly of emerging markets. As they go through stages of rapid development, they tend to experience real currency appreciation. While that's something of a mega trend in terms of just developing economies showing these higher returns potentially, it's also, though, however, shrouded in a lot of volatility. And I think what distinguishes FX trends is, of course, the big swings around them. And I think you have to both get the sort of megatrend theme right, but you also have to have the correct entry point. I think that's really critical with foreign exchange.
And speaking about one currency in particular in more detail, the euro has now eliminated 17 national currencies so far. Has it made life for investors easier?
Well, I think it's certainly made it easier if you're within the euro area and you're managing risk. You have a different nature of risk today, but you certainly don't have the old cross-border currency risk within the eurozone you used to have. What you have now, though, is something different and not necessarily truly easier to manage, which of course is the credit risk more directly. What makes the euro really distinct is that it's converted the domestic debts of countries into essentially foreign debts, and it's put them in a rather different position. So I think it does help in one sense that it's cleaner. You don't have the cross-border currency risk, but you do have really quite a different and quite complex set of credit and geopolitical and socioeconomic risks to face.
And you're from Ireland, a country which has adopted the euro, but you live in Switzerland, which has kept its own currency. Does it make any difference?
I think it makes a really big difference. I mean, in general, having your own currency would really make the most sense. I mean, there are certain conditions under which a currency union could be optimal, but actually for most of the Eurozone, and particularly Ireland, it's not clear that this is really fulfilled. At the same time, Ireland has really benefited from being within EMU, in terms of overall economic growth and the side effects of that. Things, of course, have gone into an adjustment phase now due both to global factors and the excesses of the early years of EMU within Ireland. But overall, I think we will continue on a path to say staying in the euro, and being in the euro in the first place is really of net great benefit to Ireland, starting obviously from a relatively lower GDP base. For Switzerland, I think the case that being outside makes the most sense pretty clearly holds, although we would note that there is some burden to that. Swiss fundamentals, of course, have been really relatively good, and that means a lot of capital inflow to the country, and that causes distortions, and you can see the National Bank has had to react to that and take some quite extreme measures. So not quite entirely avoiding some kind of linkage to the Eurozone. But I think staying outside for Switzerland clearly makes the most sense.
And speaking about currency unions, do you think we'll see any more of these in the future in Asia, for example, or in South America?
I think you will have occasionally some movements towards currency unions in other areas, and we've seen this from time to time. I doubt, however, you will have another meaningful currency union like the Eurozone anywhere in the world in the foreseeable future. And the reason for that is that the degree of political cooperation required, I mean, the loss of sovereignty that must be given over, and yet there still is a sovereign state behind it. The degree of cooperation represented is exceptional. The logistical challenge of EMU was also truly exceptional, and I think is really something that would be extremely difficult to replicate. I think you will have movement more towards currency cooperation in some regions, also in the Middle East, for example. I think you will see some steps in that direction, but I don't think we'll see another EMU.
Thanks, Joe. For more information on market movements and global trends, check out News and Expertise on the Credit Suisse website.